Leasing is an arrangement or agreement by a lessor to a lessee. Now, you know there are two parties to a leasing agreement, the lessor and the lessee. You would have studied it in accounting. I will explain to you all shortly. All right. Leasing is governed under the Income Tax Leasing Rule 1986. Now, there are two parties to the leasing. The owners of the asset are known as the lessor, and in this case, the leasing company is known as the lessor. The leasing company is known as the lessor. All right. So here will be the leasing company. Now, the lessee is the party that rents out the asset. All right. So there are two parties, the lessor and the lessee. Now, under accounting too, you studied two different types of lease, the finance lease and the operating lease. Now, for tax purposes, we do not recognize finance lease as a lease. Finance lease is not recognized as a lease for tax. It is considered a hire purchase transaction. So please remember that when we talk about leasing, we are only talking about operating lease. Finance lease is not considered a leasing transaction for tax purposes. It's considered a hire purchase transaction. So for a finance lease or a hire purchase transaction, for the leasing company, which is the lessor, the leasing company cannot claim capital allowances on the lease asset. This is because they only provide a loan to the lessee to buy the asset. They are not the owners of the asset. They already sold the asset to the lessee. So they have no ownership over the asset. Therefore, they cannot claim capital as capital allowances. All right. For the leasing company, their income is the hire purchase interest is considered the income for the company. All right. The hire purchase interest is considered the income for the company. So this comes under hire purchase transaction. This would come under hire purchase transaction. All right. Now, for the lessee, sorry guys. For the lessee, since they are the owner of the asset, they can claim capital allowances on the capital portion of the asset. That's the general rule, guys. So when you are paying the installment, only the capital portion of the installment qualifies for you to claim capital allowances. So the capital portion of the asset is the qualifying capital expenditure. Interest portion that you pay becomes a deductible expense for the lessee. All right, guys? Any question? Now, for an operating lease, Only an operating lease is considered a leasing business for a leasing company. Please remember that only operating lease is considered a leasing business of for the company. Now, because the leasing company, the lessor now, is the owners of the asset, they can claim capital allowances because they have met all conditions to claim capital allowances. What are the conditions to claim capital allowances? You must have a business income. So their leasing business, it's considered a business income. Leasing business is considered a business income. They have incurred the capital expenditure. They actually bought the asset. All right. Therefore, they can actually claim capital allowances. Asset should be used in the business to generate income. So it is actually used in the leasing business. So they have met all conditions to claim capital allowances. All right. Now, the income to the lessor is the lease rental. Capital plus interest. Whatever they get as their lease rental is the income to the leasing company. Now, for the lessee under an operating lease, they cannot claim capital allowances. Why? Because they are not owners of the asset. They only have the right to use the asset. After they use the asset, they must return it to the leasing company. So they are not the owners of the asset. They cannot claim capital allowances. Now, lease rental is a deductible expense for the lessee. The whole portion, interest as well as capital. Any question, guys? Now, for a leasing company, they are required to separate their hire purchase business and their leasing business. So they are required to have two business sources. One is their leasing business and one is their hire purchase business. They cannot, until statutory income, both these businesses needs to be separated. Both these businesses needs to be separated. It needs to be separated until statutory income. After statutory income, you can combine the business to minus your brought forward losses. But until statutory income, both these businesses needs to be treated separately. All right, so you need to calculate adjusted income for each one of them, minus capital income in their own respective business. Only after statutory income can you combine that. All right, now, when you're looking at business expenses, all expenses are which are deductible under Section 33 and Section 34 is allowed as a deduction under both hire purchase income business as well as leasing business. All right. Obviously, Section 39 expenses are not deductible. Now, all direct expenses related to leasing business or hire purchase business. Sorry, did someone say something? Someone's mic was on. Did they say something? So any direct expenses that is related to leasing business can be deductible against the leasing business. Any direct expenses that is related to the hire purchase business can be deducted against the hire purchase business. Now, there are certain expenses which are known as common expenses, such as salaries paid to employees, because they could be involved in the leasing business as well as the non-leasing business. So when it comes to these people's salary, I cannot separate, I cannot like say, oh, half of you belong to half of your body belongs to leasing, half of your body belongs to hire purchase. I cannot do so. Rental, I take a whole office. So in my office, there is leasing business also being conducted and there's non-leasing business also to be conducted. So how am I going to separate my rental? Utility like electricity, water, amenities for staff like coffee, biscuits, and things like that that you buy for your staff to use. Maintenance of your office. Now, all this are common expenses because both leasing as well as non-leasing business takes place in the same place. So because of that, since these are common expenses, these common expenses need to be apportioned. This common expenses needs to be apportioned between leasing business and non-leasing business. So your leasing business, you will have your leasing income over total income times common expenses. All right. And the same goes for your non-leasing business, which is your hire purchase business. Non-leasing income over total income times common expenses. This is how you apportion your common expenses. Remember, only common expenses needs to be apportioned. Direct expenses, you take it to their direct businesses. Minus it against their direct businesses. Like I said, leasing direct expenses minus against leasing business. Hire purchase direct expenses minus against hire purchase business. All right. Now, the same thing goes with capital allowances. Now, lease assets, assets that you have bought and leased out, the capital allowances for this lease assets can only be minused against your leasing business. Can only be minused against your leasing business. All right. However, there are common assets. There are common assets, such as aircon in the office, computers in the office, telephones in the office, furnitures, fittings in the office, all right, carpets, blinds, all this. These are common assets. Assets used in the office or used for administration purposes. This assets, the capital allowances for this assets needs to be apportioned between non-leasing business and leasing business using the same type of formula, leasing income over total income times common capital allowances, non-leasing income over total income times your common capital allowances. Any question, guys? Any question?
No.
Okay. Now, I'm going to do regulation 4 with you all. So if you actually look at your slides, there are quite a few slides relating to regulation 4. All right. Now, what does regulation 4 says? Now, regulation 4 says when there is a lease of assets and you actually have leased out these assets and you have told Inland Revenue, these are lease assets, these are operating lease, I have leased this asset. However, if any one of these conditions are met, any one of it is met, Inland Revenue will say this is not a leasing transaction, but this is a hire purchase transaction. So although the company can tell that it's an operating lease, Inland Revenue takes it as a finance lease, so they deem it to be a hire purchase transaction. So these are not considered leasing operations or leasing transactions. Not considered, all right? And it's governed under your income tax leasing rule. Now, the first condition is, now here you don't have to meet all conditions. Either one of these conditions is met, it automatically becomes a hire purchase transaction. Lessee given option to buy the asset when the lease period expires. So at the end of the lease period, the lessee can buy over the asset at whatever value that the lessor says. Then Inland Revenue says, you always had intention for the lessee to own the asset. Therefore, this is considered a hire purchase transaction and not a leasing transaction. All right. Now, lessee able to buy the asset during or after the lease period for an amount less than market value. So they can actually buy the asset during the lease period or even after the lease period for any amount less than 80% of market value. If it's anything more than 80% of market value, then it's considered a leasing transaction. But the moment the lessee can buy the asset for anything less than 80% of market value, it's no longer considered a leasing transaction. All right. Lessee has beneficial ownership of the asset. Lessee has beneficial ownership of the asset. Now here, the lessee is able to modify the asset and use the asset in whatever way fits his organization, change the asset or do whatever he does to the asset. Then Inland Revenue says this is no longer a leasing transaction because they don't, now the lessee has the right to do anything they want to the asset. So not just the right to use the asset, they have the right to do anything they want to do to the asset. So they can change the whole function of the asset. So it means that the asset belongs to them. It looks like the asset belongs to them. Also, if the lessee is now undertaking to maintain the asset, anything goes wrong with the assets, they are the one who repairs, they are the one who pays for it, annual maintenance, they are the one who's paying for it. So it looks like the lessee owns the asset. So in this case, it is deemed to be a hire purchase transaction. Special purpose asset. Now, here, the lessee is the only one who has any use of that asset. Example, you know what an accelerator is, right? Now, an accelerator is made to fit one floor to another. Now, if you go from building to building, the height of the floors are different. So when you actually build an accelerator, you're building the accelerator specifically for that one building. So if I was to buy an accelerator and lease it out to a lessee, when the lessee has no more use to it and they return it to me as the lessor, I cannot use it anymore because I cannot take this accelerator and go and fit it into another building because the length may be different. The height may be different. All right. So in that case, this asset can only belong to that particular lessee. If that lessee no longer has the use of the asset, then I cannot do anything with the asset. It becomes a scrap to me. All right. So in that case, the Inland Revenue deems that you bought the asset specifically for the lessee. So this is more of a hire purchase rather than a leasing transaction. Now, lessee has the right to dispose of the asset and keep the proceed. That means the lessee has the right to sell the asset. So the lessee decides who to sell the asset to and how much to sell the asset for. So the lessor has no say on it. So in this case, Inland Revenue says, it looks like it's the lessee's asset, but he sells the asset, he keeps the money. So this is a hire purchase transaction, not a leasing transaction. Now, sale and lease back. Here is where the lessee would claim capital allowances before selling the asset. Okay. Let me explain to you. All right. Say the lessee buys the asset in year one. So year one, lessee will claim capital allowances. Now, the asset, the lessee owns the asset for year one and year two. So year one and year two, the lessee claims capital allowances. Year three, the lessee sells the asset to the lessor. And in year three itself, the lessee now lease the asset back from the lessor. So technically, when year three, the lessee sells the asset to the lessee cannot claim capital allowances. The lessor must claim capital allowances. But Inland Revenue says, if you wanted the asset, why did you sell it? You could have kept the asset, carried on claiming capital allowances. Why did you sell it to the lessor and lease it back from the lessor? So Inland Revenue says that here the lessee is doing tax avoidance. So in order to stop them from doing tax avoidance, any asset where the lessee has claimed capital allowances and then sell it to the lessor and lease it back is deemed to be hire purchase transaction rather than leasing transaction. This is especially when lessee and lessor are related parties. So they try to play with the capital allowances in order to gain maximum tax relief for both parties. So in this case, Inland Revenue says, nope, this is certainly a hire purchase transaction and not a leasing transaction. All right. Okay, now there are a few examples. So I will do the first example with you. These are all from your slides, all right, guys? Accident Berhad lease a machinery for 20,000 a month for 20 months from 1st May 2015. The asset costs 300,000. The lessee purchased the asset for $10 at the end of the lease period. So because he asset cost 300,000, but you only bought it for $10. So at the end of the lease, the machinery was acquired either than market value, less than 80% of market value. So under Regulation 4, it's deemed a sales transaction. So this is deemed to be a hire purchase transaction. So it's not a leasing transaction. So if it's not a leasing transaction, right? So it's considered a non-leasing business. So interest portion is taxable for lessor. All right. And lessor cannot claim capital allowances. Lessor cannot claim capital allowances. All right. So for the lessor, this is the income for 2015, and this is the lessor's income for 2016. This is the lessor's income for 2016. All right. While it's an income for the lessor, please remember it's also a deductible expense for the lessee. Only interest portion. Okay, let me show you how they got this interest portion. So here, this is the installment you paid. 20,000 a month times by 20 months. So total you paid was 400,000. The cost of machinery was 300,000. So the difference between the installment you paid and the cost of the machinery is your interest, is your hire purchase interest. All right. So interest per month is your 100,000 divided by 20 months is 5,000 per month. That's why you get this 5,000 here. It's 5,000 per month because your total interest for 20 months is 100,000. So per month is 5,000. So for 2015, you started on 1st May. So until year end, 31st December, is 8 months. That's why your total interest is 40,000. For 2016 is 12 months times by 5,000, so it's 60,000. So this is the income for the lessor, and it's a deductible expense for the lessee. Now, your capital allowances. Remember, only lessee can claim capital allowances. So in 2015, the capital allowances claimed by the lessee is the whole installment is 20,000 per month. But in this 20,000, there is 5,000 interest. Remember, only capital portion qualifies for QCE. All right, only capital portion qualifies for your qualifying capital expenditure. So I need to minus off my interest portion. And how many installments did I pay in 2015? 8 installments. So 15,000 times by 8, I get 120,000. That's how you get the 15,000 here. All right, the 15,000 here is 20,000, which is your total installment. Minus your 5,000, which is your interest portion. You get the 15,000, which is your capital portion. All right, this is your capital portion. Now, so your capital portion 15,000 times by 8 months, you will get 120,000. Now remember, any new capital expenditure incurred, you get initial allowances. So 120,000 times 20%, initial allowances is 24,000. You also get annual allowances, 120,000 times by 14%. Your annual allowance is 16,800. So your residual expenditure is 79,200. QCE minus initial allowances minus annual allowances, we have residual expenditure 79,200. Now 2016 capital expenditure, again your installment minus interest, 15,000 times by 12 months. This is what is shown here. Your capital expenditure incurred in 2016 is 180,000. Remember, every time you incur a new capital expenditure, you can claim initial allowances. So initial allowances will be 180,000 times 20%, 36,000. Annual allowances. Now, annual allowances will be the capital expenditure you incurred in 2015 plus whatever capital expenditure you incurred in 2016. So 180,000 plus 120,000, you can claim 14%. annual allowances. So that will be 42,000. So your residual expenditure will be the residual expenditure in 2015 plus the new capital expenditure you incurred in 2016 minus your initial allowances minus your annual allowances, you will get a residual expenditure of 181,200. Guys, if you go and look at your tax 1 capital allowances slides, you have learned this there. All right, so please go look it up. Now, sales and lease back. Lessee owns an asset for 3 years, sold to lessee a machine for 3 million. Lessee owns the asset for 3 years, sold the machine to the lessor for 3 million. Lessee Sdn Bhd leased it back for 30 months from 1st May 2015 at a monthly installment of 120. Now, because first and foremost, lessee owned the asset, all right, and then after that sold it to the lessor and leased it back from the lessor. This is clearly a sale and lease back. So it is deemed to be a hire purchase agreement. All right. So only interest portion taxable to the lessor. Lessor cannot claim capital allowances. All right. Now, balancing charge. Since the lessee disposed the asset, they may have a balancing allowance or a balancing charge. All right. Now, let me explain to you what's balancing allowance or a balancing charge. Okay. This is your QCE for year 1, 2015, 2016, and 2017. All right. Okay. So 2015 QCE, QCE or QPEQ, qualifying plant expenditure or qualifying capital expenditure, all right? Yeah, it's 800,000. All right, so your initial allowances will be 800,000 times 20%. Your annual allowance will be 800,000 times, say, 14%. $160,000. This 112,000. So your residual expenditure would be 800,000. $528,000. 2016 QCE $1.2 million. So initial allowances is 1.2 million times 20%. Annual allowances is 1.2 million plus 800,000 times 14%. So this one is 240,000. $280,000. Your residual expenditure $1.208, and 2017 the QCE is $1 million. Again, your initial allowances would be 1 million times 20%. Your AA now, annual allowances would be 1.2 million plus 800,000 plus 1 million times 14%. This is 200,000. $3 million and 420,000. So this is your residual expenditure after year 3. So they say they sold it for 3 million. So your disposal price, say, is 3 million. Please. Yeah. Now your disposal price is more than your residual expenditure. So in this case, you will have a balancing charge. Since your disposal price is more than your residual expenditure. So you will have a balancing charge of 1412. And this 412 will be added to the statutory income. This will be added to your statutory income. This balancing charge increases the company's tax. So by actually doing this, lessees and Berhad will now incur additional tax. Therefore, it's not a good tax planning. All right. So that's why the lease sale and lease back transaction was brought in order to ensure tax avoidance doesn't take place. Now, your special purpose asset, A. Sundram Berhad, lease the centralized air conditioning for 120,000 a month for 30 months from 1st May 2015. The asset cost 3 million. How is the treatment for the profit for the lease or for the lessor? Now, because it's a centralized account, like I told you, each building has a different measurement. So when you put centralized account, it can only be used for that building. Once I take it out, I have no more use for it. So because of that, it is deemed a special purpose asset. Here, interest portion is taxed on the lessor. Lessor cannot claim capital allowances. Right, lessor cannot claim capital allowances. Okay, let me do regulation 3 with you first, and then I'll come back to do your tutorial question 3. Now, regulation 3 says that there are certain times where the lease rental changes from month to month or year to year. Say this year, I pay 20,000 a month. Come year 2, I pay 30,000 a month. Come year 4, I pay 40,000 a month. So that means annually, your lease rental differs year to year or month to month. Now, regulation 3 says, I don't care if your lease rental differs from month to month. As far as inland revenue is concerned, lease rental remains the same every month throughout the lease period. It doesn't matter if in the earlier periods lease rental is lower, in the later periods lease rental is higher. Now, the reason regulation 3 was brought in is to prevent tax avoidance, especially among related parties. So, for related parties, it is deemed lease rental accrues evenly throughout the lease period. Now, please remember, regulation 3 will not be applicable to floating lease. Floating lease is where the lessor takes a loan to buy the asset and leases out to the lessee. So here, the lessor has a funding cost. So when their funding cost goes up, the interest that they charge the lessee will eventually go up because the lessor has a funding cost. All right, and their funding cost will always be based on the BLR, base lending rate. So when their funding cost goes up, the interest portion on the lease rental to the lessee will go up. This is deemed to be floating lease. So when they sign the agreement itself, it is deemed to be a floating lease. So regulation 3 will not be applicable to floating lease. All right. Now I will show you an example on what regulation 3 means. Now this is not in your, it's not part of your tutorial. It's not in your slides. It's an example I'm giving you all. All right. Now, HM Leasing Sdn Bhd is a locally incorporated company whose accounting date ends on 31st December. The company carries on business of leasing heavy road construction machineries. Now, it leased out a machine to R&B Sdn Bhd on 1st January 2018 for a period of 3 years under a special arrangement under which the lease payment will be as follows. In 2018, lease payment is 30,000 per month. 2019 lease payment is 45,000 per month. In 2020 lease payment is 50,000 a month. All right. Advise the company on the tax implication of the arrangement by reference to the income tax leasing regulation. So here they're talking about regulation 3. All right. So in 2018, your lease rental is 30,000 a month times by 12 is 360,000. In 2019, your lease rental is 45,000 per month times by 12, 540,000. In 2020, your lease rental is 50,000 a month times by 12 is 600,000. So your total lease rental for the 3 years is 1.5 million. All right. So 1.5 million divide by 36 months, you should get 41,667. So although you see my lease rental is 30,000 in 2018, 45,000 in 2019, 50,000 in 2020, inland revenue, IRB will take the lease rental to be 41,667 per month throughout 2018 to 2019. So IRB will ignore this. IRB will say, I don't care whether you charge 30,000 or 40,000. So the annual income taxable per year will be 2018 41,667 times by 12. You get 500,000. I rounded it up, guys. So 2019 will be the same. And 2020 will also be the same. So end of the day, still 1.5 million, but the only difference is it accrues the same for every year. You all follow? Any question, guys? Okay, let's look at question 3. Now, list 3 examples of when a lease will be deemed to be sale under Income Tax Regulation 1986. Explain the tax treatment for the lease payment made by the lessee and the amount received by the lessor if the arrangement is a pure lease arrangement, if the arrangement is deemed deemed sales agreement. This is your hire purchase, guys. Now, part C, integrated leasing. Integrating leasing operates both leasing and hire purchase activities. The following information was given in relation to the year 2016. Gross income, 800,000, 400,000. Adjusted income before taking into account interest and common expenses, 200,000, 100,000. Capital allowances, lease asset, 800,000. Obviously, hire purchase is nothing. Common expenses, 60,000. Interest cost is 45,000. Common capital allowances is 30,000. Compute the aggregate income for aggregate integrity leasing for the year of assessment 2016, right? As stipulated in the Income Tax Regulation Act. All right, guys, I'm going to show you C first. How to calculate using your formula. Okay, guys, just give me a moment. Okay. Never mind. Let me work it out here. Okay. So first and foremost, you're working. Now, common expenses. Is your, okay, for leasing business. The formula is leasing income over total income times your common expenses. All right. So here, your leasing income is 800,000 over 800,000 plus 400,000 times what's your common expenses? 60,000. Give you 40,000. Round up, guys. So your non-leasing will be 400,000 divided by 1.2 million times by 60,000. It should give you 20,000. Okay. Now capital allowances. Again, for your leasing income, over total income times common capital allowances. So it's 800,000 over 1.2 million. So your common capital allowances, 30,000. For non-leasing, $400,000 divided by 1.2 million. Should give you 10,000. Interest cost, Your interest cost should give you the same answer. Sorry, guys. Leasing. $800,000 over 1.2. Times by 45,000. Okay, guys. Let me just, since we're running out of time, let me just share this with you. Okay. So interest cost, okay, leasing business, I have 200,000 adjusted income. All right, according to the question, my interest cost is 800,000 divided by 1.2 million times 45. So my interest cost related to my leasing business is 30,000. Common expenses we worked out just now, 40,000. So 200,000 adjusted income minus another 70,000. So your new adjusted income would be 130,000 minus capital allowances directly on lease assets, as the question says, is 80,000. We worked out your common assets, common capital allowances to be 20,000. So total capital allowances deductible against your leasing business is 100,000. So this is your statutory income for leasing business. Now, your non-leasing business, your adjusted income was 100,000. Interest, 400,000 divided by 1.2 million times 45. The portion that is related to non-leasing is 15,000. Common expenses, we worked out 20,000. So total expenses deductible against your adjusted income is 35,000, giving you a new adjusted income of 65,000. All right, your capital allowances on common assets, we worked out 10,000. So this is your statutory income. For your non-leasing business, 55,000. So your total aggregate income is your 30,000 plus 55,000, giving you an 85,000. So this. And this together gives you 85,000. All right, guys, any question? No, thank you so much for being with me on a public holiday. I really appreciate it. If you have no questions, you may log off. If you have any questions, you can stay back and ask me.
Miss, I joined it just now, so do you mind to share the QR code?
Sorry?
Do you mind to share the QR code? I joined it just
Had the what?
the QR code.
Oh, okay. Right.